Hey everyone, it's Thomas Skublak, your local Ontario real estate expert. Today, we're breaking down everything you need to know about getting a mortgage in Ontario in 2026. We're talking about the terms, the types of mortgages, the process, and how to avoid mistakes that could cost you tens of thousands of dollars. Full disclosure, I'm not a mortgage broker in this video. This is purely about giving you the information you need to make the right financial decisions. Also, just a heads up, this isn't professional advice. This video is broad and based on my understanding. Always seek a qualified professional for more accurate, personalized guidance. So if you want to be smart, save money, and get into your next home safely, stick around. So what is a mortgage? Let's start simple. A mortgage is a loan to buy real estate. There are different types: fixed rate mortgages, variable rate mortgages, lines of credit, or collateral mortgages. The purpose of a mortgage is simple. It helps you afford a home by spreading payments over time. Think about it. Paying for a home in cash is nearly impossible for most people. Meanwhile, every month you pay rent, you're helping someone else build their wealth, not your own. Stats Canada shows the difference in net worth over a lifetime. Renters at retirement have around $29,000. Homeowners at retirement have roughly $1 million. That's why getting into the market as early as possible can dramatically increase your net worth over time. Let's talk about how mortgages work. Mortgages are monthly payments of principal plus interest. Early on, most of your payment goes to interest. Later, more goes to principal. You have fixed versus variable rates. A fixed rate, your interest stays the same for the term. Variable rate, your interest can go up or down with the Bank of Canada. Variable rates can be tricky. You can have adjustable payments. Your payment changes as your rate changes. Fixed payments, your payment stays the same even if your rate changes. Most of the time, adjustable payments are smarter, especially in a rising interest rate environment, because you have flexibility to prepay without penalties. Here's what you need to know. Amortization period is the total time to pay off your mortgage. Standard is 25 years, but you can now do 30. Shorter amortization equals higher payments with less interest over time. Longer amortization equals lower payments, more interest. The term is the length of your mortgage contract. Usually, you can pick between 1 to 5 years. Principal is the amount you owe. Paying extra with prepayment privileges can save thousands in interest. You have closed versus open mortgage. Closed mortgage is lower rate but penalties if you pay off early. Open is a higher rate, pay off anytime without penalty. Penalties, there are 3 types: 3-month interest, interest rate differential, and a flat fee. Pro tip, always follow the 3P rule: product, penalty, price. Pick the right mortgage product first, understand the penalties second, then focus on the rate. Let's talk about mortgage insurance. If your down payment is less than 20%, mortgage insurance is mandatory. It protects the lender, not you. Usually added to the mortgage. Can be government-backed, CMHC, or private. The key difference: government-backed equals 100% coverage, private equals 95%. Down payment rules: $500,000 to $1 million, minimum down payment increases. Over $1 million, mortgage insurance is not available. Let's talk about how to get a mortgage. Where to get a mortgage? Banks, familiar but higher penalties. Employee obligation is to shareholders, not you. Mortgage brokers have access to multiple lenders, including private lenders, are obligated to act in your best interest. You have discount mortgage websites, sometimes good, sometimes risky. You have credit unions, which are often local, have limited flexibility, and usually non-portable. What is a pre-approval? It's an estimate of what you can borrow. You must include employment verification and down payment proof. Only consider homes with your pre-approval limit. Full approval is once an offer is accepted, your broker submits all documents, a commitment letter is issued, the lawyer reviews mortgage agreement and facilitates closing. You bring the remaining down payment plus legal fees plus the land transfer tax, and you have yourself a closed deal. Let's talk about first-time homebuyer tips. Budget wisely. Don't max out your pre-approval. Factor in property taxes, utilities, maintenance, and repairs. Trust professionals for advice, such as realtors, brokers, and lawyers you trust. Use prepayment privileges to pay off your mortgage faster if possible. So that's your 2026 Ontario mortgage breakdown: the terms, the types, pitfalls, and the best strategies. If you're buying your first home or upgrading, understanding mortgages is the first step to saving thousands and making a smart investment. Click the link in the description for more resources, tools, and Ontario specific guides. I'm Thomas Skublak. Thanks for watching, and I'll see you in the next video.